Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is well-timed. This is one of Paul Sweeney's favorite guests. He's like the guy in the fixed income market. If there were train rails through BlackRock, Paul, this is the guy with his ear on the train rail, trying to figure out what's coming down the pike. Why don't you bring in Russ here with decades?
Absolutely. Russ Brownback joins us here. He's Deputy CIO of Global Fixed Income at little shop called BlackRock. I think they run a couple dollars over there. Russ, talk to us about the fixed income business here. You guys have had a good 2025. I see a lot of green on the screen when I look across the fixed income total return page on the Bloomberg terminal. Credit's been rewarded this year. I'm looking at high yield, high single digit returns, leverage loans, same type of thing, mortgage-backed securities, all that stuff. How are you guys thinking about fixed income market?
Yep, it's the most exciting environment we've ever seen. Our team's been at it for a really long time. And, this is an income harvesting regime in fixed income. And think about all the different dynamics over the course of this year. So much uncertainty. Markets have had a series of spasms that create opportunities to tactically trade around that. When you put it all together with, pretty good overall systemic credit quality, and build a diversified portfolio, get a little bit of lift from interest rates that have come down over the course of this year. The aggregate index is on pace for equity-like returns this year. So it's been the best year for fixed income in a decade.
This is the single great unspoken of the last 18 months is bonds are in a bull market. Yeah. Nobody knows it.
Nope. You think back to, the 2022, the tough year that was for everybody, including the fixed income market here. As we look ahead here, what do we need for the fixed income market to continue to perform? Is it the Fed aggressively cutting rates? Is it just corporate performance remaining strong? What are some of the drivers?
Yeah, so, I think a very large catalyst this coming year is going to be as that policy rate comes down. We think the Fed will deliver what's priced into markets, which is down close to neutral by the third or fourth quarter of next year. And then you start to think about those trillions of dollars sitting in cash today. And cash has been a very high Sharpe ratio allocation heretofore for the last 6 or 8 quarters. I think that money will begin to migrate into some longer tenors as some of those investors look to lock in this opportunity set. And we don't see a lot of overall duration beta move in this coming year. So again, it's going to be about harvesting that income.
What in God's name? What did you say? A duration beta move?
So in other words,
they were a great band. They did Emerson, Lake and Palmer, like no one. Duration beta move. What is that?
So we think the yield curve is pretty close to an equilibrium today. So the front end is priced to where it thinks the Fed will be delivering the policy rate. That's the equilibrium. The back end is gravitating towards nominal GDP growth outcomes. That's about in fair value today. So in other words, we don't see a big directional move in rates over the next year. So instead, it's about finding that optimal income expression today and just holding it over the course of the year.
So talk to us about the credit profile out there in the marketplace today. We've had some concerning issues in the private market that kind of people are starting to wonder, is that representative of some more broader credit concerns out there in the marketplace? How do you guys think about that?
So overall systemic credit quality is very, very good. If you look at the financial earnings in the third quarter and look at the credit quality, so you saw for all 3 quarters of this year, sequential improvement in delinquencies, charge-offs for the major banks. Even, if you look at the largest auto lenders in the country, you've seen similar improvement in credit quality. There are sort of, the economy is very dispersed in terms of outcomes. You've got pockets of the economy that are suffering from onerously high borrowing costs today. And so you do have dispersion underneath that overall systemic quality. So that's an awesome environment for picking individual credits, picking winners, avoiding losers. So the dispersion is a great way to find alpha.
Russ Brownback was with us with BlackRock, and we continue this morning on trying to find yield here. So the basic idea is to clip a coupon. Within strategic income, you guys are killing it here with good relative performance. If it's a bull market in being strategic, what's the the mystery strategic out there forward? What are you thinking about now to get to the 4th of July next year?
So, I think when you think about the world we're entering going forward, animal spirits are really reviving, both in terms of, the CapEx super cycle that's underway, as well as we're anticipating a great deal of an uptick in M&A activity. Lots of that will get financed in the public credit markets, some of it in the private credit markets. That origination is an amazing opportunity. So you guys on the show over the past few days have talked about the burst of supply we've had recently related to CapEx. When you take the net supply, I'll use the investment grade index as an example. When you subtract gross issuance and you take away the amount that's maturing the same year and then the coupon that gets thrown off that needs to be reinvested, we've only had 1% of the total market cap of the investment grade index in net issuance. Compare that to the treasury market, where they're borrowing the equivalent of 10% every year because of deficits. And so we would welcome an increase in supply, particularly if it comes at a concession in markets. That's a great opportunity to harvest some.
Well, you're the first phone call. I mean, if I'm on the desk at Goldman Sachs or Morgan Stanley, I'm calling you guys first, right?
Well, we think origination is an alpha source, both in the public markets and increasingly in the private markets, where we're seeing bilateral opportunities.
I can sell my whole deal to these guys. There's like 20 people.
No, it's true. They make like five phone calls.
Come on, BlackRock.
We got to continue this. Don't be a stranger. Russ Brownback with us, Deputy CIO, Global Fixed Income at BlackRock. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It's the most intelligent note on institutional tension I have seen in ages. Amy Wu Silverman joins us, definitive and derivative strategy at RBC Capital Markets. Okay, you and I aren't going to do a quantitative finance Imperial College walkthrough here. We're not going to go all Nassim Taleb. But what we are going to do is explain institutions. I can't say the phrase, it's not appropriate for radio. They're scared, you know what? And the answer is they're hedging, but they're hiding it. They're afraid, they're hedging their risks, but it's shadow hedging. Discuss.
So, I had a client say to me the other day, Tom, that they have never seen so many fully invested bears, himself included. And, when I talk about shadow hedging, essentially what I mean is I think there is going to be a lot of demand for hedging when we make that first drawdown. The reason you don't see it in the market right now is because it's not there. But, one of my jobs is to walk around and talk to different hedge funds and portfolio managers. And I can tell you they want that downside confirmation first. And a lot of them will deploy.
Cocktail conversation. How do you define drawdown off SPX? Is it a correction? Is it negative 5%? Is it a bear market? What's drawdown for you looking at a convenient average?
Yeah, great question. In derivatives world, we measure everything in standard deviations, but I think to keep it simple, something that's on the order of 7 to 10% drawdown. You can. My friend Lori calls it a garden variety drawdown in her Tears of Fear. But I think they're looking for that, and then if they see momentum factor confirmation there on the downside, which we haven't all year, we haven't since COVID, then I think you do have a cohort who is ready to step in and hedge more. But remember, they've been kind of whiplashed by this retail buy the dip phenomenon that's been so strong. And that's why I think they've kept it in the shadows this time and not in the light of day.
I love your notes. They're so helpful here. The one that jumps out at me is two huge risks for investors have been one, right tail, i.e. that you risk that you aren't participating in up crashes. Haven't heard that term before. That's cool.
Up crash.
Yeah,
up crashes,
I'm going to use that. And two, heavy concentration. We've heard that concentration risk in the marketplace. Are they trying to hedge some of that concentration risk out at all?
They're not. I mean, the way they're hedging it is they end up quite concentrated, meaning they probably hold more NVIDIA or more Mag 7 than they would like. That makes them the fully invested bear. But they're very cognizant of the risks, both of this kind of circularity in AI. It makes them very anxious. They just don't feel like they have an alternative, especially when you have the other side sort of stepping in all this time since April 2nd and bowing the market. That's why I think this downside confirmation factor becomes really critical.
one of the things that we're going to have to deal with that we don't ordinarily deal with is we're going to get a deluge of economic data if and when the government opens soon. Do your clients come to you and say, I think that's some risk, or it might be opportunity. I don't know. How are they positioning for that, if at all?
So I think this is actually really interesting because one kind of breakdown and relationship in options is typically volatility goes up when the market goes down, right? There's this spot down, vol up phenomenon that's essentially broken down. Now what we're actually seeing is this idea of the up crash. So volatility actually can go up when the market goes up. And if we get data that says, there's definitely going to be 25 bips in December, you could get an up crash.
We're going nerd on you. Amy Wu Silverman with us, RBC Capital Markets, Chief Nerd Michael McGlone on deck here in Miami. Okay, Amy, just for you, Mike from Belmont called in and said, Tom, do something on the terminal. Thank you, Mike, for that pro tip. So I take SPX and I go down 2 standard deviations, negative 2 standard deviations off trend, 20-week look back. I'm working in weekly units, not daily units, because that's what pros do. If I go down 10.50%, I finally get down 2 standard deviations. That's the drawdown you're talking about.
Yeah. And again, most people characterize that as a garden variety drawdown. One thing we like to do is there's 2 metrics you can look up on Bloomberg, SDEX and TDX. One measures a 1 standard deviation drawdown, and TDX actually measures a 3 standard deviation drawdown. They're both incredibly inexpensive right now, which tells you that hedging isn't real yet. It's just shadow hedging.
Clients, it's like guests tell you.
Can you come in daily
and give us a tutorial on the Bloomberg terminal? Exactly. Sorry. So where's the opportunity? Where's the risk out there in the marketplace for you right now? When you talk to your clients, what are you hearing?
Yeah, to me, one of the biggest risks is just this component of correlation, which is something that, tends to increase when things go down sharply. I think this is behind all the angst you hear from institutional investors, because a lot of them lived through GFC. A lot of them lived through the times when correlation goes up like a knife. And that's why I think, these hedges, which don't look that expensive right now, that cover your tails, is something that's compelling to people, even though it's shadow hedging.
What's the fear? I mean, your note is brilliant on how institutions are not with retail in this bull market. Futures new high for the day, up 27. The level here getting up near 6,900. Amy Wu Silverman, in 1987, there was an ugly day where I learned how to spell portfolio insurance. Where's the portfolio insurance of 2026?
I think it's something simple like either NASDAQ or S&P, just simple puts. And the reason I say that is because a lot of what's been going well is very concentrated, and it's also very self-referential because it is just the stock market wealth. And so if you do lose the leg of the school of retail because they look at their portfolios and it's going down where they're trying to buy the dip, then I think you could get into this kind of circularity that you're seeing in AI where they're like, wait a minute, this isn't going to work for us. And that's your correlation spike you need.
How about if we have something more than a garden variety drawdown decline in the marketplace? Do you think the retail investors will be there at that point?
So I don't. And I'll tell you one reason. It's a lot of this cohort is generational, right? And so when you think about the kind of market they've seen a 2010 to now market where you do buy the dip. It makes sense. If you get an extended run where, volatility is very high volatility regime and continuous drawdowns, and you get that confirmation of that downside momentum factor, I think that's what institutional investors are worried about.
Okay, we got to go here. Mike McGlone's people just emailed and said he's got to come on. November 12th. Okay, December 12th, 2025. There's no tour scheduled. So it's the Taylor Swift, the Eras Tour, the final show movie on Disney Plus. How big is the party at the Silverman house?
I actually didn't even know about this one.
Your daughter told me.
I know. She's probably going to shake her head that I didn't know this. We'll have to do a viewing
December
together.
12th, it's a viewing.
Thank you.
It's destination TV.
It's on my calendar.
Will that do well for Disney Plus, Paul?
Oh, I think that'll be good for Disney Plus. Yep.
Amy Wu Silverman, brilliant on shadow hedging. Just I can't say enough. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Rohit Chopra with us with Lazard Asset Management. Lazard's just having a great year. I mean, Peter Orszag, the place is pumped. I mean, I see Lazard everywhere.
We're playing to win.
Well, you're playing to win, but come on, Orzag's doing this with a certain panache. Has he been home? Like, has he been in New York one day in the last 6 months?
It's a great question. I think the context is intellectual curiosity, working with our clients and partnering to drive industry.
For Global Wall Street now, in the fervor of this boom that we're in, what's the Lazard distinction? As you grind it out every day there, what's the distinction?
It's fundamental. It's long-term. We represent, and we're very fortunate to represent long-term assets, pensioners. We're fundamental, focusing on profitability and identifying great opportunities.
Right, perfect segue into the reality that Beijing and China have an x-axis completely different than we do. China develops long-term. You're hugely plus on China equities. Link that into their geopolitics.
Tom, I think the context of emerging markets is evolution. We are moving beyond foundational, basic emerging markets that's driving convergence. China is at the forefront of that. Historically, it was about manufacturing, exporting to the U.S. consumer. What you found is that they have really focused and honed in on the future of technologies. We've seen that in terms of EV penetration. Today in China, for example, over 50% of new cars are EV. You're seeing that in terms of battery storage. See some of your biotech areas. So you're seeing a focus on the next generation of technologies. And the context is that emerging markets is not just a convergence story. Parts of emerging markets are driving the fourth industrialization. We're seeing that in Asia, North Asia as well, Taiwan, Korea, particularly around some of the AI themes.
So for a while there, my China proxy is Alibaba. That's it. That's all I know. And then it was doing so well for all the reasons we all understand. Then the government came in and put the kibosh on a lot of the tech there. And that was 3 or 4 years out in the desert. Nobody could care about China. It's back, right? And why is it back?
I think it's back because there's pragmatism in Beijing. We need to bring back the private sector and engage and develop that social contract with the youth. I think it's also the fact that there's been a lot of innovation. DeepSeek earlier this year highlighted that China is in this race. They're evolving. And the context of these are national champions that are helping drive and evolve the economy.
This is too important. Over the weekend, LVMH announces 4 new Tiffany's and Louis Vuittons and all that in Beijing. Great. Lazard's telling me that we have a Xi shift back towards Deng, back towards a more capitalistic China. Do you actually observe that at Lazard?
So I think it's really important to understand your alignment with Beijing and understand your alignment with the major companies. In emerging markets, you do tend to find that state-owned enterprises are majority controlled by the government. I think the context here is that it's not a monolithic story. You have to understand the nuance, and the nuance is quite important. We spent a lot of time understanding that dynamic with the major shareholders. What's the vision of these businesses? But I do think the context of the last couple of weeks is showing Mr. Trump and Xi are speaking to each other. These are 2 very important economies, and the context of emerging markets more broadly is we just finished a lost decade for the asset class. And now with emerging markets up nearly 30% year to date, investor interest is starting to improve. And it's not just about short-termism in these assets. We're seeing parts of this asset class are driving innovation. There's the development of foundational opportunities. Think about India today, for example. The middle class in India is the story's just starting. Per capita incomes there just started are around $2,500. You're seeing a shift occurring where people are traveling. Consumers are buying homes for the first time. Think about Latin America. Rates are so high today. You haven't even seen a credit cycle. We're starting to see the beginnings of a credit cycle. And through that whole backdrop, I think that the level of maturity across the emerging markets in terms of central bank monetary policy has been quite orthodox. They learned their lessons from the taper tantrum back in 2013.
I know you have a big exposure to, a little birdie whispered in my ear just a moment ago, in China and in Asia. Talk to us about India, though. You just mentioned India. I mean, a lot of folks were telling me when China was maybe not investable, but people were just down on China. People were saying Don't worry about China. Look to India. That is the next story there. How do you guys think about that?
So long term, we believe in the India story. I mean, as I mentioned, the economy is now hit to around a little over $3 trillion, 2,500 per capita. Consumers are consuming for the first time. People are buying homes for the first time. You're seeing that development. I think from a national strategic context, India wants to be in the global supply chain manufacturing side. Yep. I think Modi is very much focused on helping sort of move the society from the agrarian society to more urbanization. Valuations are challenging in certain areas, but I do think that looking out over the next 10 years, we think India is the largest, fastest growing economy, and GDP should double.
Is there anybody at Lazard not from the London School of Economics? Is it like an Orzag requirement? You have to have some LSE in here?
I think economic history I studied at the London School of Economics really important. Helps you develop context. Particularly when thinking about geopolitical events and investments.
A threat to society or people that haven't studied any economic history. Right, just as simple as I can on India then as well. Please discuss tariffs, the summary of Lazard's thought. Paul had this yesterday. How can we be over the tariff angst yet? We're not, are we?
We're getting close. The expectations that we would have seen a trade deal early in July, and that did not occur. I think we're now at a point where there's more optimism on that side. We're hearing favorable dynamics. I think there's been more dialogue between the two. I think the context of where India can serve as a true partner with the United States from manufacturing, from India needs to also improve and modernize a lot of its industrial sector. And then at the same time, the large non-resident Indian community here in the U.S. and the private sector are quite engaged. So I'm optimistic. I think that we're going to see some positive developments over the coming months.
As an emerging market manager, how much time do you spend out of the U.S. visiting these countries?
A lot. It's a key part of the job. I will say what's really important as an investor in emerging markets. You need to think holistically. It's not about just traveling and meeting companies and reporting yesterday's news. You've got to stress and push some of the scenarios. I think we also have the ability as a global emerging market investor to bring perspective. So how the development that we're seeing in China, how does that impact the path that a country like Brazil is going to experience, or what Mexico may be doing right now around tariff negotiations? So that is really important. I think we view that as an edge, and then as a result, because we represent long-term money, we can think fundamentally, and that to us is the market inefficiency.
Rohit, thank you so much. Rohit Chopra with us with Lazard Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Welcome to the first episode of Odd Lots. I'm Joe Weisenthal, co-host of What Do You Miss and editor of Bloomberg Markets.
And I'm Tracy Alloway, executive editor of Bloomberg Markets.
Here at Odd Lots, we want to have a discussion every week about economics, finance, markets, market structure, which Tracy loves, maybe some politics and culture thrown in, stuff that doesn't necessarily fit into the normal day-to-day conversation. And we couldn't think of any guest better to have than Tom Keene.
Am I a guinea pig?
You're the guinea pig.
Okay, thank you. It was really something. Good morning, all of you across the nation and around the world. Good morning on YouTube. Please subscribe to Bloomberg Podcasts. Odd Lots with a 10th year. I was definitely a guinea pig, and you guys were so desperate that you didn't have anybody else to talk to. Tracy Alloway, Joe Weisenthal, in celebration of what they have wrought. How did you two meet? I need to start with that. You were at the Financial Times. I would read, I said this the other day in a taping. You read Tracy Alloway, and you're like, Damn it, she's smart. Joe Weisenthal single-handedly changed journalism and Business Insider. Did you meet before Bloomberg or here?
We met before Bloomberg. We mostly met on the internet. We had met at a bar, probably at some sort of journalist happy hour or something.
Well, so Joe was always sort of a presence just floating in the ether of the internet in my head. But the first time we met in person, I remember distinctly because it was at a bar in Midtown. And I was excited to meet you. And I go up to you, and you know how the first time you meet someone, you expect a little bit of small talk. How's it going? The first question Joe asked me was, what do you think is going on with the Eurozone? And that was it. And the whole conversation was just about the Eurozone after that.
Boy, that sounds fun.
Yeah, it was fun. We've been having fun talking about the Eurozone ever since. That was the first time in 10 years that I've listened to that intro to the first ever episode.
It's actually better than I thought.
Yeah, I was going to say the same thing. It didn't sound quite as bad and awkward as I expected. I have my memories from that time, The first episode with Tom was great, but my memories from that time was it was very uncomfortable figuring out what we were doing on the podcast. It didn't sound terrible, did it?
No, you make it up as you go.
That's right.
I have a cardinal rule. I never, ever listen to anything in the past.
You can't.
The only time I've broken that rule, Paul, was Joe Stiglitz and Ken Rogoff at Davos. That's the only thing I've ever listened to. Paul, pick it up here.
Tracy, how has the podcast evolved over these 10 years? Have you guys changed the way you kind of think about it?
Yeah, actually that intro wasn't too bad in terms of framing what we were going to do. But we were very lucky. We had a very long runway in doing this because, as you said, even 10 years ago, podcasts were not as popular as they are now. And so we launched this before Bloomberg even had a podcast team. We were doing it with radio. And,
we have a team, right? We have a team.
Now we probably have a team. Yeah.
So shout out to Bloomberg Podcasts, of course. But, no one was really listening. No one internally was pressuring us to make sure that we were growing. And so we were really allowed to explore and figure out what it is that we wanted to talk about.
I do think in the beginning, we had this impulse. It's let's just talk about anything other than what's in the news.
Yeah.
Right. And so it's okay, the news is talking about the Fed, et cetera. So we'll talk to Tom Keene about banjos and guitars and charting by hand and stuff like that, because this is not something that would ever, be in the news. Over time, I think we've definitely become a little bit more, we hew to the news, but not intensely. We did an episode this week about the dairy industry. Was that something prime in the news? Not really. So we sort of mix it up still, but it's become a bit more timely, I guess you'd say.
I'm amazed, I'm sure you guys are as well, just how many podcasts there are now. Yeah. It's such a popular medium for everybody, from the famous folks down to people you've never heard of that just want to, get their voice out. How do you guys kind of position your podcast with all the stuff that's out there?
We get asked about competition quite a lot. And I've heard of people launching podcasts because they want their own odd lots at competitors. I hear that all the time. It probably bothers me a little bit more than Joe. It
flatters me, yeah.
But the only response you could possibly do is just keep on going and try to have the best, most engaging interviews possible and the best content. So we kind of just keep doing what we have been doing.
John Micklethwaite, editor-in-chief of Bloomberg News, out with a note today on the celebration of Joe Weisenthal, Tracy Alloway, and Odd Lots. At the back end of his note, he's looking for stadium tours. What's the plan forward? Are you going to keep it under 10,000 live events, or can you pop out to 20,000?
I think we'll play Darrell Royal Stadium in Austin, Texas one day. That's obviously the dream. No, this is the fun thing, which is that because we have this community of listeners that we've built for a long time, we've been able to, it is mostly still a podcast, but we have a daily newsletter, and we have a Discord channel where people get together online and they chat 24/7 about topics they're interested in relating to things we talk about. And we've been doing more and more live shows. We did more in 2025 than we did in 2024, and I think 2026 will be a big year for that. It's fun meeting fans in various cities and seeing what they're into. And so hopefully across the country, maybe some in Europe. I don't know, maybe Hong Kong.
Pixie dust I have, and I don't know where I got this from. I'm going to blame it on my father. Both of you don't talk down to your audience. How do you do that, Tracy?
I think this is really important to understand. I think the media has a tendency maybe to oversimplify things. Bullet points became very popular. I'm not saying that there isn't a place for summaries and simplification, but I think what we've discovered through Odd Lots is that people really want to learn. And what ends up happening is we do one episode on a topic. Semiconductors is the classic example. We started talking about those in early 2020, and then everyone just gets interested in it. We get interested in it, and we just do more and more hours, and we learn alongside our listeners.
Is there a guest that you've wanted to get, you just haven't gotten yet?
Not really. I mean, look, you can always list big names that would be fun to have on the podcast. I just don't really think about
Chris Stapleton.
Okay. Yes. There's some major country stars I'd love to have on. No, but for real, like, there's always names, right? There's always, I never had Elon
All I know
Musk
is I get
on,
people soliciting me. Can you get me on Odd Lots?
Well,
I'm
anytime you hear that, you know what's funny? I always tell people, if you have an idea, pitch it. And people think I'm joking or like,
I'm going to pitch it right now.
We're always here for the pitching.
Ready?
Yeah.
Here's the Odd Lots guest for Joe Weisenthal.
Okay.
Tracy, you can play along as well. You must speak with John McBride of Blackbird Studio in Nashville.
Great. I'd love to do that episode.
Who has the largest collection of the stuff that someone like Chris Stapleton sings.
I would love to do that
He's
episode.
Martina McBride's husband. And do
you have a contact with him?
Call up Blackbird.
All right.
Use my name and they'll hang up. But
See, this is how we end up with an Odd Lots live show in Nashville.
Yes.
I was at the Bloomberg Cafe years ago, and the studs are in the back row, including a younger John McBride. But John McBride deserves to be on Odd Lots.
I think that'd be a great episode.
That would be a great episode.
That's how it works.
I'm sorry, Tracy. I just said
right.
Tracy will like it too.
I like country.
Yeah.
I just want to say, Tom, thank you for being our first guest.
Yes, thank you so
You're
much.
the best first guest we could imagine.
Great honor. And, Odd Lots here, a 10th anniversary celebration. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get right to it. With futures up 24, joy in the markets, joy with the newspapers. Here's Lisa Mateo.
Okay, we've been hearing a lot about all the spending going into AI, but where is the money coming from for these mega deals? That's the question, right? So the Wall Street Journal actually has a look into some of the deals of some of the biggest AI infrastructure ones, Meta, OpenAI, XAI, and it shows actually some creative, sometimes risky funding options. They call them Frankenstein financing because they're picking and pulling from different places. So I'll give you an example. Okay, so Blue Owl Capital, they stuck with Meta, their joint venture to build this giant data center in Louisiana. But sources are telling the Wall Street Journal, Blue Owl buying private equity into the deal. They're bringing the private equity into the deal. They're also receiving a debt-like guarantee from Meta if the partnership falls apart. Then you look into the deal involving OpenAI and Oracle, and the Wall Street Journal says it involves a lending group of more than 30 banks. So this is where they're doing it. There's a lot of issues behind it, but a lot to get into in that article. You're going to have to take a look at it for yourself because it's very detailed, and I kind of lost track.
It's private equity, it's private credit, track. It's banks.
Yes.
They're just looking for capital anywhere. And these are companies, Meta, Google, that have just ironclad balance sheets, but even their balance sheets are being challenged here. Some of these spending.
We don't have the time here. I could go on all day about this. Paul, been there, done that. Have you seen this before?
I haven't seen the dollars here. The dollars today are just
scope and
extraordinary.
scale.
Yep.
I mean, okay, next, what do you got?
Okay, this one is about Harvard. So the school says they're handing out too many A's to students. There was a report that the school put out. It shows grade inflation across the board. New faculty says they're surprised at how lenient grading is. The students, they're not happy about it. They say they deserve the grades. They say they study a lot. They sleep a little bit. They stress out. They feel Harvard should kind of move the goalposts.
Right.
So that's what they're saying. A lot of students saying,
it doesn't matter what your GPA is out of Harvard. You've got the Harvard name. You're done.
Okay. It's major specific is our wonderful conversation with Troy Gajewski of MIT the other day. If you look at the different majors in the school, Lisa, whether it's Harvard or Slippery Rock, I don't care.
Yeah.
There are certain majors where there's no grade inflation, like economics, like engineering, like medicine. Paul, give me some other names here.
No, I think those are the science, the hard ones. Yep.
Yeah, chemistry, which is the toughest major in any school. Everybody knows that. The rest of them, everybody gets an A. I mean, I've lived it in my family. Absolutely. Get me a Tito's and Tank in the control room on an emergency basis. Next.
I stressed you out. Okay, we all know Apple users, they love their iPhones, right? But a lot of people are making it part of their outfit. Apple wants to capitalize on this with wearable iPhone fashion. I kid you not. It is teaming up with Japanese luxury fashion brand Issey Miyake for this limited time iPhone Pocket. Okay, you can check it out on their website. It goes on sale Friday. So the Pocket, it looks like a sock, like it comes in a number of colors. It's kind of knit. There's a short one and a long one. Okay, the long one, it's like a crossbody. Okay, it's about $230 just to slip your little iPhone in there.
But isn't that a license for somebody to steal your fancy? I mean, this is
kind of putting it out there.
Yeah. People are stealing iPhones.
Yeah.
Am I wrong?
No.
True.
No,
it's like putting a flag on it saying, here I am.
Here I am. Come get me.
It is. And they're attaching them to their bags like those little
I see all the tourists here in New York, they've got the little packs that go across their shoulders and across their breast. And I noticed it when I was in Italy, everybody had it. I mean, so people I'm like, just put it in your front pocket. Put your wallet in your front pocket.
It's a fashion statement.
But
I didn't even realize, like, Issey Miyake did the black turtlenecks that Steve Jobs wore. I never knew.
Should I get the fashion debate right now quickly? Should I get the big scarf? Gary Oldman, everybody's
John
wearing
Farrell
now
looks good in the
big scarf. Does he have the big? He's fashion plate.
Really? Like John Tucker does?
Should I do like
Tucker has
fashion plate of the
This is from LRP.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.